Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. With market sentiment as your foundation, it's time to put strategy into action. We'll explore practical approaches for using sentiment analysis to enter, manage, and exit trades with confidence. Trend-following strategies with sentiment confirmation. Market sentiment can also confirm existing price trends. Strong bullish sentiment often reinforces an uptrend, while pervasive bearish sentiment can confirm a downtrend. Traders can use this alignment of sentiment and price to identify better entry and exit points. Consider these scenarios. Bullish sentiment reinforcing an uptrend. If a stock is in a clear uptrend and sentiment indicators like a low put-call ratio or positive social media buzz are also strongly positive, it confirms the trend's strength. This might be a good time to add to a long position or initiate a new one. Bearish sentiment confirming a downtrend. When an asset is declining and sentiment indicators like a high VIX or negative news flow show high fear, it suggests the downtrend has more room to run. This could signal a good entry for a short position or reason to exit a long one. Sentiment acts as an extra layer of conviction. If price and sentiment agree, your confidence in the trade can increase. Hedging and risk management in volatile sentiment environments. Sentiment analysis is a powerful tool for managing risk, especially when the market feels volatile. You can adjust your hedging strategies based on the prevailing mood. Here's how traders can use sentiment for risk management. Increasing hedges during extreme bullishness. When sentiment is overly optimistic, it often signals that the market is due for a pullback. You might increase your hedges like buying put options to protect existing long positions from a potential reversal. Managing risk during periods of extreme fear. In times of high fear, markets can crash rapidly. Sentiment indicators can warn you when panic selling is likely. This might lead you to reduce your position sizes or tighten your stop-loss orders. Stop-loss orders are critical in sentiment-driven markets. When sentiment shifts abruptly, prices can move quickly against your position. Placing clear stop-loss levels helps limit potential losses. Adjusting your position sizing based on sentiment is also wise. During periods of heightened uncertainty, taking smaller positions can reduce your overall exposure to risk. Integrating sentiment analysis with technical and fundamental analysis. So far, we've talked about how to read market sentiment and how it can shape your trading strategies. But sentiment really shines when you combine it with other analytical tools. Think of it like a three-legged stool. Technical analysis, charts and price patterns, fundamental analysis, company financials and economic data, and sentiment analysis, the market's mood. When all three support each other, you get a much stronger foundation for your trading decisions. This integrated approach helps you confirm your ideas and spot opportunities you might otherwise miss, using sentiment to confirm technical patterns. Technical analysis helps us spot patterns and trends in price movements. When you add sentiment to the mix, it can give you extra confidence in those patterns. Imagine you see a stock's price nearing a key resistance level or approaching a crucial support zone. Sentiment can be the tiebreaker. Here's how it works. Bullish sentiment and breakouts. Let's say a stock you're watching is pushing against a strong resistance level. Your charts suggest it might break out. If sentiment indicators like a very low put-call ratio or overwhelmingly positive social media buzz show strong optimism, it lends conviction to that rumored breakout. The market mood supports the technical signal, increasing the chances of a successful upward move. You're not just seeing a pattern. You're seeing a pattern fueled by collective momentum. Bearish sentiment and breakdowns. On the flip side, if a stock is hovering near a key support level and looks set to fall, bearish sentiment can add serious weight to that prediction. A rising VIX or widespread negative news, for example, could indicate fear is taking over. This bearish sentiment tells you that many investors are losing confidence, making a breakdown below support more likely. It's the market's collective dread pushing prices lower. Combining these elements helps you avoid false signals. A technical pattern looks great, but if sentiment contradicts it, you might want to wait or re-evaluate. When they align, your trading ideas become much more robust. Sentiment is a leading indicator for fundamental shifts. Sometimes, shifts in market sentiment actually happen before fundamental changes become widely known. This gives you an early heads up. It's like feeling a change in the wind before you see the storm clouds gather. Consider these points. Early warning signs. A sudden wave of negative sentiment around a company might precede an earnings disappointment. People on social media or in financial forums might pick up on whispers or small pieces of information before they turn into official news. This shift in mood can be an early warning of impending operational or financial issues. Anticipating opportunities. Conversely, growing positive sentiment around a developing technology or a new industry trend can signal a coming fundamental shift. Investors might start flocking to related stocks before the significant revenue growth or industry-wide adoption officially begins. This can offer an early opportunity to invest in companies that are poised for growth. Sentiment, in these cases, acts as a vanguard signal. It tells you what smart money or attentive market participants might already be sensing, even if the official numbers haven't caught up yet. By paying attention to these shifts in mood, you can position yourself strategically before the broader market reacts to formal fundamental announcements. This proactive approach can make a significant difference in your timing. Challenges and limitations of relying solely on market sentiment. While market sentiment offers a powerful lens into investor psychology and potential market movements, it is never a foolproof guide. Relying only on sentiment without considering its inherent challenges can lead to poor decisions. Sentiment is often subjective, can shift quickly, and sometimes sends misleading signals. Understanding these caveats is essential for building a robust trading strategy. Sentiment is a short-term versus long-term indicator. Market sentiment is often seen as a barometer for immediate price swings. It tends to be quite volatile, making it particularly useful for short-term trading strategies where quick reactions to mood shifts are common. Think of how a sudden news headline can cause a stock to jump or drop within minutes. That is sentiment at play in the short term. However, extreme long-term sentiment can also provide critical signals. When bullishness reaches extreme levels, everyone is optimistic, and asset prices are often highly inflated. This can signal a major market top, where a reversal is due. Similarly, when pessimism is widespread and fear dominates, markets might be hitting a bottom. During these times, assets are typically oversold. So, while daily sentiment shows swings, long-term extremes can mark significant turning points. It is about recognizing the difference between daily noise and the broad, exhausted mood of the market. The danger of following the crowd blindly. It is tempting to just go with the flow when market sentiment is overwhelmingly clear. If everyone is buying, it feels safer to buy too. But following the crowd without independent analysis can be risky. History is full of examples where the majority was wrong. Consider the idea of a bull trap. This happens when prices briefly rally, making everyone think an uptrend is starting, drawing in buyers. But the rally quickly fails, and prices drop again, trapping those who bought in. This occurs because the underlying sentiment was not strong enough to sustain the move, or perhaps smart money was actually selling into the rally. On the other hand, a bear trap occurs when prices fall sharply, convincing traders a downtrend is in full swing. People start selling, but prices then quickly reverse upward, catching sellers off guard. These traps highlight why critical thinking is so vital. You must always question why sentiment is leaning a certain way and whether fundamental data or technical patterns support that view. Do not let the crowd's enthusiasm or fear override your own careful analysis. Market sentiment is crucial for every trader. It offers unique insights into the market's mood, helping to explain why prices move the way they do. Yet, sentiment is only one piece of the puzzle. The best strategies come from blending sentiment analysis with technical indicators and fundamental data. This combined approach allows for smarter decisions and better risk management. Understanding the limitations of sentiment alone helps avoid pitfalls, ensuring you trade with confidence rather than just following the crowd. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.